What's good, people? Today we're looking through liquidity pools in episode 5 of Chop. Okay, so by the end of this video you're going to have a basic to intermediate understanding of what is a liquidity pool, why they're used, and advantages and disadvantages of using a liquidity pool. Okay, so before we get into liquidity pool specifically, we're just going to have a look at the traditional solution. Okay, so on legacy platforms such as, let's say, a Forex platform or a centralized cryptocurrency exchange, we use something called a order book. Okay, now the order book is how we swap crypto asset A into crypto asset B. Okay, so if we just have a look on the left hand side, we can see the order book, and in red that's the ask limit order, and in green that is the buy limit order. Okay, now the ask limit order is the lowest price a seller is willing to sell at. Okay, and a buy limit order, which is also called a bid, is the highest price that a buyer is willing to buy at. Okay, so all you need to know there is there are orders on the exchange. Okay, so the red is the ask price, the lowest price a buyer, the lowest price a seller is willing to sell at. Okay, and the green is a bid price, so it is the highest price a buyer is willing to buy at. Okay, so you can see swapping crypto asset A, let's say Tether for example, into Bitcoin. A exchange will have the price of, let's say, a Bitcoin in Tether. Okay, and it will use what we call a matching engine to match these limit orders together. So centralized exchanges will have a matching engine that matches all of the ask limit orders with all of the bid limit orders. Okay, and just quickly we go over a matching engine. So it consists of servers, and many of them consist of Apache Kafka, which essentially is just an example of a client server system there, which is used for data processing. And we can see each pair has its own client server system and used for data flow there at the end. Okay, but I won't go too much into trading engine architecture there. Okay, so just a brief understanding of the traditional order book for you. Now I'm just going to go over an example. So traditional order books have something that we call liquidity. Okay, now if we look at exchange A, okay, let's say we have a person called Jill. Jill wants to come and she wants to buy 5,000 amount of this coin. Okay, now we can see exchange A, it has 1,000 at that price, $9,200. It has 1,000 at 9,300, going all the way up to 9,600. Okay, now we can see exchange B, it has 10,000 at all of those price points. So that means exchange B has more liquidity than exchange A. Now if Jill was to buy 5,000 of this coin, okay, she's going to use up all the liquidity over this price range from 9,200 to 9,600. Okay, so now two things. Not only is she paying more on exchange A than she would on exchange B, because she's buying up price ranges, as you can see. She's spending a bit more, well, $100 more for each price point. So not only is she paying more on exchange A than she would on exchange B, because on exchange B she would buy 5,000 all at the same price range because there's more liquidity. Okay, but the person who comes in after Jill will have to buy on exchange A at the next available ask price. Okay, we went over ask prices on the last slide. So the ask price is 9,700 after Jill's taken up all the liquidity. So that's the next available sell order on the exchange. Okay, so the advantage would be for the trader coming in after Jill on exchange B. Why? Because on exchange B there is still 5,000 amount of this coin left at that lower price point. Okay, so not only would Jill save money, but the person who's coming in after Jill, they'd actually get a better deal using exchange B. Okay, so that's what liquidity is briefly. Now let's go over the order book just in a bit more detail. Okay, so if we look at number one is the last traded price on the exchange. Okay, so each centralized exchange will have potentially a different last traded price, okay, which is why you will see number two on many order books. Number two is essentially it's a global index price of the asset. Okay, so say this is a coin, this is the price of that coin as an index. Okay, so it's like a reference point, and this is used so there's not local let's say manipulation of prices on the exchange. Okay, so you'll see order books include a reference price also. Now three, as we said before, these are the ask order prices. So these are traders on the exchange who said they're willing to sell at a minimum of these prices, okay, with the quantity of the orders there and a cumulative total of the price there. Okay, and as we said before, number four in the green is the bid limit orders. Okay, so these are the orders placed by the buyers. So buyers will come onto the exchange and say, when the price reaches this, I want to buy. Okay, so they're going to place their bid orders there. Okay, so let's just go over market makers now. Okay, so if we go back to the previous example, and after Jill did her trade on exchange A, remember the next available ask order was at 9,700, which meant that if a new seller wanted to come in and if the market price was lower than 9,700 on that exchange, if they did a market order, it would fill at 9,700. So that would be called what we call a high slippage, okay, which is what we don't want. Now, in order to get rid of high slippage, we use something called market makers. Okay, we want, or exchanges want to have liquidity at the whole range within what the coin or asset might trade at. Okay, so let's say we have that seller now with his limit order on that exchange A. Okay, he has a ask limit order of $9,700. Okay, so Jill's come, she's done her trade. Okay, now we have someone called Anne come onto exchange A. Okay, now Anne puts a bid order in, okay, at 9,200. Okay, now since there's no liquidity, that trade is not going to get filled. Okay, because we have 9,700 there at order from John, and we have a bid order from Anne at 9,200. Okay, so there's no way the matching engine can match those two prices. Okay, so let's assume the actual market price of this asset is 9,600. Okay, so what Anne then does is Anne wants to put a market order in on the exchange. Okay, so if Anne puts a market order in on that exchange, what would then happen is the order on that exchange A, it would still get filled locally. Okay, so Anne would still have to pay 9,700 because the next available market order on the exchange is 9,700. Okay, so it would be high slippage. Okay, and Anne would lose out around $100. Okay, because the exchange has low liquidity. So even though Anne might be able to get that coin somewhere else for 9,600, because the next ask order on that local exchange A is 9,700, she would lose $100 out to slippage. Okay, so this is where market makers come in now. Yeah, let's have a look. So the market maker would say, okay, I'm going to provide liquidity to this exchange, okay, and I'm going to put a little commission on, so let's say $0.05. Okay, so we're going to have a ask price of 9,600.05. okay, so Anne will buy from us at 9,600.05, and we will pocket that $0.05 per trade. Okay, So the market maker obviously has a lot more capital deployed, okay? So they can afford to have that amount of coin, and therefore they can afford to supply that to the exchange and make money from each trade, okay? Now, what DeFi does, okay, is it takes control and reliance away from centralized market makers and order books. Okay, so what Uniswap is Uniswap is a type of automated market maker. Okay, now there is different types of automated market makers. There is constant function market makers, okay, which Uniswap is a type of. But then underneath constant function market makers, we have constant sum market makers, constant product market makers, and constant mean market makers. Okay, so Uniswap is a constant product market maker. And why it is a constant product market maker is because the equation is x times y equals k. So x times y is actually a product. It's the multiplication of two separate things, okay? So that's going to become more clear when we do an example. Okay, so it's going to go over a quick example. So the equation that governs Uniswap is x times y equals k, okay? So k has to be a constant, right? So what we're going to do is we're going to do a quick example, and then after the example you're going to understand this more. Okay, so let's imagine we have a liquidity pool. Okay, so this is our liquidity pool. In our liquidity pool we have a quantity of token A, which is represented by the x-axis, and a quantity of token B represented by the y-axis. Okay, so we know x is A and y is B. Okay, so x times y is equal to k. When you plot that curve out, you're going to have a curve like this. Okay, so let's say for example's sake that this liquidity pool has a quantity of 10 of coin X and 10 of coin Y at the beginning. Okay, so we know X times Y equals 100. So we know K is 100. Okay, so on the left hand side, this is our liquidity pool, these two. On the right hand side, I'm going to put a user. So let's assume this user called John has 5 of coin X, coin A, and it has 10 of coin Y, which is coin B. Okay, so we put him on the right hand side, and what John is going to do is he is going to interact with this liquidity pool. He's going to exchange some X, token X, and he's going to receive some token Y. Okay, so let's say he wants to exchange 2 of token X. Okay, so we've said -2, so he has 3 of token X available now because he's given 2 to the liquidity pool. Okay, so let's add 2 to the liquidity pool. Okay, so he has 12. So no, sorry, the liquidity pool now has 12. Okay, so if we have a look on the x-axis, we've gone from old position to a new position along the x-axis. You can see, because if we start here and if we increase on the x-axis, we're going to get to this point. But to get to this point and still follow the curve, you see we have to go down on the y-axis, okay, which means that the quantity of token B in the pool, which is Y, has to decrease. Okay, so the user has to gain a Y amount of tokens, and this liquidity pool has to lose this amount of token that the user gains. So what we need to do now is work out the amount of Y that we have gone down by in this liquidity pool. Okay, so to do that, as we said before, we use the equation x times y equals k. Now you always use the original values for this, so that's the original values of the liquidity pool. We had 10 of each token, so that's 10 times 10 equals 100. So we know k is 100. Okay, so what we have to do now is we have to put in the new situation. Okay, we know the new situation is we have gone up on our x-axis by 2. So we know we have 12 on the x-axis now. So we know this because the user gave us 2 of his tokens. Okay, so we have 12 times y, because we want to work out what the new y is. We've gone up on the x-axis, down on the y, so we want to work out the new position of y. So that's why we keep y here as a constant, okay, because we want to work out what it is. Okay, and then we can say equals to 100. Okay, now we know k is 100 because we just worked it out. Okay, so then rearrange this for y. We get y equals 8.33. Okay, so we've gone from an old position of y being 10 to a new position of y being 8.33. Okay, so what we can do then is say 10 minus 8.33 is 1.67. Okay, so we've gone down on the y-axis by 1.67. So this means the liquidity pool has lost 1.67 of y tokens, okay, but the user has gained 1.67 of y tokens. Okay. So as we can see, we've just done this calculation here. 10 minus 1.67, the new value of y in the liquidity pool is 8.33. Okay, and the user, let's add the 1.67. The user now has 11.67 of token y. Okay, so that was just a brief example and showing how simple it is actually to use this equation, x times y equals k. And this is how a liquidity pool functions. So this is what the smart contract, if it's Ethereum, this is what Solidity will be doing on the smart contract. When we go on the Uniface interface, you will put in the amount of token A you want to swap, and then it will do the calculation instantly, and it will tell you this is the amount of token Y you will gain. Okay, so when it does that, this is the logic that it's going through. Okay, you're going to also see this equation written in this form. Okay, now this looks a bit more complicated, but it's exactly the same thing that we've just worked out. The only difference being, instead of the equation saying x times y equals k, we just have a difference in x here showing and a difference in y here showing. Okay, so the difference in x would be the amount of x that we added to the liquidity pool, so that would be +2. Okay, and the amount of y that has changed, the amount of change is just represented by a triangle. That would be what we've just worked out. So all you do in this case, you'd rearrange it to get this, okay, and then you would fill in all of the constants. Okay, we just worked out y to be 1.67. Okay, so you would just do it exactly the same. K we know was 100. Change in x we know was, I believe it was 2. So it was 3, and the original x was 10 and the original y was 10. Okay, so it's exactly the same, just written slightly differently. Okay, now Uniswap V3 uses something that we call concentrated liquidity. So we just did an example on Uniswap V2. Okay, now on Uniswap V2, if we just look at this little chart here, okay, the whole chart is colored, so that means on Uniswap V2 the liquidity is distributed evenly along that x times y equals k price curve, okay, with assets reserved for all prices between 0 and infinity. So all that means is, even though we only might use a slight amount of this curve, the amount of capital that is allocated is spread out along the curve. Now this is only important if you are providing liquidity to Uniswap or to an automatic market maker. If you are just using Uniswap to exchange coin A into coin B, this is not relevant. Okay, but I thought I'd include this just because Uniswap V3 is more efficient than V2. So let's assume we're providing liquidity. Okay, on V2, the majority of liquidity is never put to use, because as we just saw in the last example, if we look at this here, the old price was here, the new price was here. Outside of that little area, the rest of the deployed liquidity was not getting used. Okay, Now, what Uniswap V3 does is it allows you to concentrate that liquidity between two areas. So if you, for example, think that the asset, in this case, Ethereum, is going to trade between 1,000 to 2,500 for an X amount of time, and if you're providing liquidity, all what you would do is you would concentrate your liquidity between those two ranges there, okay? And as you can see, the V3 strategy is much more capital effective than the V2 strategy, okay? Now, sometimes you're going to see Uniswap V3 explained and shown in diagrams as this chart of virtual reserves to real reserves, okay? Now this looks a bit more complex, this chart, but it's not. It's quite simple, but potentially I could do another video on this just because it would require a bit more time to explain, okay? And Uniswap V3 is also utilizing what we call tick distribution, okay? So the liquidity is distributed along ticks. It's distributed on a tick curve, which is a way to express a range of prices for the token to be between, okay? So I'm not going to go over virtual and real reserves and ticks on this, but there's a lot of information you can find online to explain that, okay? Now, just as we had the equation x times y equals k for Uniswap V2, Uniswap V3 works on a very similar equation. As you can see, x times y equals L squared, okay? So k is equal to L squared, which means essentially square root of k is equal to L. All L stands for is liquidity. So on Uniswap V3, the liquidity is the square root of k, okay? And we can see that liquidity is here and here. Now we have PB, which is price B, and we have PA, which is price A. So as mentioned, we can distribute the price between two different points. So that's all this means here. Price A is the lower bound of the price that we are distributed our liquidity between, and PB, price B, is the upper bound that we are distributing our liquidity between, okay? Now, impermanent loss. So one of the main dangers when providing liquidity, again, this is only if you're going to provide liquidity to a pool such as to an AMM, to an automatic market maker such as Uniswap. If you're going to provide liquidity, then a danger is losing out due to impermanent loss. If you're just going to trade it, again, there's no risk. There's only a small contract breach risk, okay, which is not really much of a danger depending on which type of automatic market maker you're using, okay? So as said, when providing liquidity, however, you need to watch out for impermanent loss. So impermanent loss is the difference between holding an asset versus providing liquidity in that asset, okay? So through providing liquidity, the user may end up with more or less of token A or B depending on market demand, okay? And since market price is changing, when the user withdraws their liquidity, the value of token A and B may be less than if the person had just held the asset instead of using it to provide liquidity, okay? Earned fees from providing liquidity may offset any losses. However, depending on how volatile the pair is, that is not guaranteed. So one should have a strong understanding of impermanent loss before providing liquidity, okay? And this chart, it just shows that if the price varies, okay, by more than this amount, so it looks to be around 25% price movement each way, then you will start to lose money. So on the y-axis, as the y-axis comes down from 0, that's indicating that you're actually losing money through providing liquidity. So anything out of this narrow range, around the 100% price, if the price of the two assets diverges by more than that amount, then you're gonna lose money providing liquidity through impermanent loss. Okay, so that's just a quick overview of impermanent loss, arguably the biggest risk of providing liquidity to a liquidity. Okay, so just to finish off, why use an automatic market maker such as Uniswap instead of a centralized exchange like Binance? Well, no KYC or sign up needed because it's smart contract based. So if you look at Uniswap, for example, more option of assets to trade because liquidity is user provided. Okay, so as I've been mentioning, if you are using an automatic market maker such as Uniswap, it's completely user provided liquidity. Okay, so users provide both of the tokens and they earn fees from these swaps happening. Okay, and as I mentioned just on the last slide, the danger of that is impermanent loss, which could be offset by the fees. Okay, so you can be your own market maker and earn fees, low barrier to entry. Okay, so not only is there more assets to trade because liquidity is bootstrapped, users are provided liquidity, it also allows communities or retail traders as a whole to earn fees. Okay, and non-custodial, so you hold your own keys. Okay, so when you use a big exchange like Binance or Coinbase, for example, that's a custodial solution because they're holding the keys to your coins. But when you're using a decentralized exchange such as Uniswap, it's non-custodial, so you hold your keys and you just use a smart contract to operate. Okay, so that was the chop. That was a quick episode, 26 minutes, and we've gone over liquidity pools.